the 13th panel of the Family Office Super Summit, Real Estate Investor Success Stories. Hear from 5 real estate investment firms who have raised over $20 million each. So we're going to keep this one focused on real estate, and we're going to keep this focused on how these firms have been able to successfully raise capital in their respective asset classes. Please keep in mind, I do get a lot of people that come up to me and say, wow, you guys have a lot of real estate investors here. And the stats on our investors are as follows. 75% of our family offices invest in real estate. On average, it makes up about 25% of their portfolio. What that means is that on average, another 75% is diversified into other niches, sub-niches, asset classes, and opportunities. So keep that in mind whenever you're talking to quote-unquote real estate investor, and make sure to ask them, do they invest outside of real estate? And many times you'll see that they have secondary funds, venture funds that are looking at emerging markets and emerging trends. And as we start to conclude today, we really want to start to dig deep into what our successful members are actually doing. What are their secrets? What are their tips to actually raising effective capital? So if we can please give another round of applause to our panelists today. Thank you. Fantastic. So before we get moving with the questions, I do want to give each panelist an opportunity to introduce themselves, their firm, and a little bit about their focus, their asset classes, and their experience. So we'll start off with Rajan.
Good morning. How's everyone doing? Good morning. Good. So my background is I ran a hedge fund for 4 years. We achieved 107% returns over those 4 years, did very well. But it was during that time that I learned about self-storage. And how many of you know self-storage is the best performing asset class in all of commercial real estate for the last 20 years? Okay, I got one. A couple of you. So, and coupled with that, it's actually the lowest risk of any asset class in commercial real estate. Right, so as an investor, what do you look for? You look for above average returns with lower risk. And when I found that out, I said, okay, I'm going to sell my hedge fund and I'm going all in on storage. And so I've been doing self-storage for the last 12 years. Sold my last portfolio to one of the public REITs, and now we're on a growth path from 10 to 100 properties over the next 5 years.
Excellent, thank you.
John Manus, Pinnacle Storage Properties out of Houston, Texas. We buy undermanaged, under-enhanced, under-expanded self-storage properties, or what we call the mom and pops. We fix them up, and same typical exit to large money player or a REIT. We own 20 properties, 15 in Texas, 2 in Oregon, 3 in Washington State. I've got 7 in the pipeline right now, 3 of which I'm raising money on. One of them's in Oregon, where we're already at, Nebraska, and Edmond, which is north of Oklahoma City. About $120 million worth of assets currently, soon to be about $160 million worth of assets.
Excellent. Thank you very much. Fadi?
Hi, I'm Fadi Eftimios with Group RMC. We do office, mainly in the Midwest and the Southeast. We're assets under management we're at about $2 billion now, and about 17 million square feet.
Thank you very much. And last but not least.
Good morning. I am Bill Lowe. I work with Prakashani Companies. Prakashani is an organization that's been built around a second-generation family, the Prakashani family out of Rhode Island. They're a real estate-focused family. Over the last 60 years, the family and the organization has deployed and completed about $5 billion plus of real estate transactions. Over the last 30, specifically, when the second generation took over, the strategy shifted towards a focus in hotels and hospitality. So over the last 30 years, we've acquired, owned, or operated, or developed over 170 hotels. Fast forward to today, we're still active in the hotel space. The name has been built into a reputable name to own and operate, and is known as one of the top owner-operators of hotels in the nation. As an example, typically we do 8 to 12 hotel acquisition deals a year. We look at other real estate opportunistically. This year, my team has deployed about $75 million of equity into hotel acquisitions, and we've completed, I think, north of $450 million worth of real estate transactions in general. And we typically partner with other family offices and ultra-high net worth individuals in joint venture structures to do so.
Excellent. Thank you very much. So to start off, I'm going to just go down the line again. I really want to hear about recent deals that have been closed, that have been and primarily acquisitions, and then we can move on into the capital raising side. So Regin, if you can just give me some examples of some really good deals that you feel very confident about in terms of the acquisition side, why you guys made those purchases, and how you guys plan to move forward on them.
Great. So we actually just closed on 2 deals 2 months ago. And this is very typical sort of deal flow that we see, or the type of deal. Everything that we're buying is off market. Right? We find that's the best way to get pricing. If you're familiar with self-storage, you'll know that it's a very fragmented business. Literally 50% of the market is owned by mom and pops. And so we go out off market. I have my director of acquisitions calling and finding these dislocated assets. And you either find that people don't know the full price for their assets. So one that we're under contract on now, we got 5 that we're under contract on. We're buying it for almost $1 million less than it should be worth because the owner doesn't happen to know what the right price is, which is great. In these other assets, we had a mismanaged or undermanaged property, 2 portfolios managed out of one site. They basically closed the other. We're able to reinvest into those acquisitions, open up the new site, the existing site, and rebuild it in a sense. So turning around the operations is what we do.
Excellent. Thank you.
So we've done 9 deals this year. Very similar to Raj. We get all of our deals off market as well, or through top level brokers that give us first looks because of our history. But the deals we've done this year is actually partnered with a small fund out of the Seattle market, and they went out and bought 5 properties that we negotiated for an ownership share in that. So we own a percentage of those 5, took those over June 1st. The other 4 were sourced off market, all in Texas, through our general network. What we look for is the undermanaged, underenhanced, underexpanded properties. So
Asset class again?
it's self-storage.
Self-storage.
Really?
Of course. But just self-storage.
Just self-storage,
Okay,
that's
got
all
it.
we do. And how we've managed to structure them is through private equity, like people in the room. We raise about 30% down, and then we sign on the debt. And the same as Raj is, we find them where people don't know the value of their property. We have one that we purchased this year in a tertiary market that was a great value. I just put one under contract on Friday that is doing the same revenue as that one, and we're purchasing it for $1.2 million less than we purchased the other one.
And can you guys remind me the differences? I mean, I guess like strategies seem to be similar here, but geographic area, are you guys?
So I'm in Atlanta, and we're focused on the 7 Southeast states.
7 Southeast
growing our
states.
footprint. And our strategies are a little different. John is amazing at what he does and has done it very, very well, continues to do well. Ours is very focused on a concentric footprint that we are growing from the Atlanta area, going out 2 hours and then 3 hours, and then eventually getting out into the Southeast United States.
We're in secondary and suburban markets and some tertiary markets. We like college towns, we like county seats, or we like the suburbia secondary markets around a major metropolitan. We try to stay out of the headlights of the REITs so that we're not paying for cash flow or cap rates.
What states are we talking about here?
I'm in Texas, Oregon, Washington State right now, soon to be in Nebraska, Oklahoma, and Tennessee. So I'm willing to go national in most states.
Great. And Fadi, again, on just recent acquisitions, deals closed.
We did about, this year we did about 600 million in deals, about 200 million of that was equity. So we're focused in the Midwest and the Southeast, and this year we're buying off institutional sellers, typically like Blackstone and Duke Realty. So we did a deal in Memphis where, that's the previous slide the gentleman was putting up. I mean, we're doing those areas right now. Cincinnati, we've done a lot in Kansas City. We're the biggest landlord in Kansas City. Indianapolis, one of the biggest in Columbus. So we've done deals in all those areas, and we try and focus on the very much secondary markets, particularly in the suburbs. But because of, I guess, our reputation and we've closed 100% of our deals, so we became a preferred buyer. So we're getting some CBD assets now. We just did a downtown deal in Cincinnati, and we're doing the PNC Tower, which I think is the second tallest building in Cincinnati. We're doing that one now.
Nice.
It's under contract. So typical deals are about 100 million. We do about 6 or 7 a year on average.
So when you're here, what are you looking for?
I mean, we're just here because we don't market at all. This is about as much marketing as we do. So we have a very good investor pool. So we've closed 100% of our deals, and we raise more equity every year. But a lot of our investors are in on a lot of our deals. So we already know going into a deal we have a lot of equity backing us. The challenge now is we're getting to see a lot of these institutional portfolios, and they have a lot of pieces to the portfolio. So we're doing more and more deals every year, and more equity needs to be raised. So we're looking for equity. We invest in our own deals, but we're going to be looking. I mean, all our deals are fully subscribed this year and going into next year as well. But the anticipated deal size we'll be doing next year will probably be our biggest. We'll probably potentially do about $1 billion in deals, so we're going to need to raise some equity, so more contacts, I guess.
Excellent. Thank you. And Will?
So historically, we've been very focused on value-add hotels, Marriott, Hyatt, Hilton, things like that, where we can go in. We have an in-house construction crew. We also have our in-house operational group. And we've done very, very well for the family as well as the investors that partner with us in the joint ventures there. I'd say this year, starting about a year and a half ago, the focus has been on areas that are defensible, and then also independent boutique hotels. So we closed, like I mentioned, we closed 11 transactions this year. The last one of interest was a 6-hotel portfolio in New Hampshire, Mill Falls Lake, New Hampshire, which was again, back to the kind of the mom and pop run hotel. The family had taken 25 years to assemble the assets, and we were able to make an acquisition of those assets earlier this year. That's been a more defensible play for us. We're seeing and putting ourselves in positions that are possibly defensible should we see a downturn or slow economy, places that people are going to drive to for a vacation rather than fly to Paris or London. We've looked at assets in Kennebunkport, and we've closed 2 assets in Nantucket, New Orleans, all under the independent boutique and typically family-owned and operated. So there's some operational levers to push and pull there once we put our operational team in place. On the New Hampshire deal, it's gone very well so far. I think we met the pref for our investors within the first 3 months.
Got it. And well, I want to ask you as well, like outside of, because obviously like you work so close with families, but outside of like that traditional like friends and family, close network, what outside avenues are you guys finding in order to raise capital? Like, have you guys had investors that have come from
so
just
we've
really
done
interesting areas that maybe you didn't expect or aren't quote unquote traditional?
Yeah, I think over the last 30 years, we've done the full gamut of where dollars come from. We've had separate accounts with the pension funds. We've had an account with CalPERS.
I'm sorry, well, a little closer for the mic.
What's that?
A little closer for the mic.
So we've kind of crossed the gamut with where dollars come from. We've worked with pension funds. We've had separate accounts with CalPERS. We've had endowment separate accounts with Brown, Harvard, and Yale. And then we've also worked with private equity groups a lot on our value add deals. And what we've found, again, we've gone full cycle back to almost the friends and family due to the cyclical nature of private equity firms. For example, we find ourselves in a lot of scenarios that the deal is really good, but at a certain year or a certain metric, the private equity partner needs to exit because of a mandate, whereas a group of 3 or 4 family offices together would realize this is generating 18% cash on cash, let's hold this for a little bit. Or in a down cycle, when a pension starts to freak out, they might not want to hold the asset through the down cycle where you can manage through it. So we've actually trended back towards individuals as well as other family offices. We have a good stable of folks that have been investing with us for 20 years, but we always try to figure out who else is out there to partner with.
Awesome. And to the self-storage guys, I want to know a little bit more about where you guys are finding some capital outside of the traditional friends and family, close network that you guys have had for years, but like maybe investors that have come in that you just met in the last 6, 12 months that maybe allocated quickly. Do you guys have stories like that to share?
So as you can tell, I do a lot of marketing.
Yep.
Okay. Even to the point that I brought my good foam finger with me.
Oh my goodness.
Storage, baby.
Nice.
Actually, I did that just for humor, but the reality is it works, and what works about it is it starts conversations. I do a lot of public speaking, not only for investor conferences, but for self-directed IRA conferences, for the storage industry, etc. In the last year to 18 months, where I found a lot of pool of money, because we raise at $50,000 a unit in syndicate deals, but we also utilize what I would call small family office that writes $1 million, $2 million checks. So we've done a hybrid of friends and family versus speaking at something like this, building a relationship with someone, and then them writing a check. Through that, in the last 3.5 years, we've placed $35 million worth of private equity and have about $10 million deployed for these 7 deals we have now. So coming to a conference like this, what I look for is finishing out the rounds on the deals that we have already. Like in the Oklahoma deal, it's wide open. It's a $2.9 million raise. So I'm looking for a single investor for that. And then I'm looking to build a relationship with someone that wants to create a small fund of $10 or $20 million. So a lot of kissing babies, a lot of shaking hands. And then what we do is we use a CRM platform where everybody goes into a database, gets organized by who they are and what they are. And then when we start our marketing program, we're raising about $1 million a month right
How
now.
much of your intention behind a lot of that marketing, the merchandise and things like that maybe aren't considered traditional, is more of a long-term play versus short-term play? Or is it more of a short-term intention, or are you guys?
It's all long-term, and the short-term piece of it is, and you can ask people in this room, there's probably 50 of you that said, nice jacket, right? And my next thing is, so what do you do?
Yeah.
Right there's an instant conversation starter.
Yeah.
So, but the conversation starter is immediate, but the relationship is the long term.
The question is like, what's the ROI on that blazer?
It's unlimited, baby. Best $250 ever.
Yeah. Plus dry cleaning.
Huh?
Plus dry cleaning.
Yeah.
Yeah. Well, I mean, and I asked.
This
because
jacket's
we get a lot.
probably raised $15-20 million out of that $35 million.
I'm getting one after this.
No, you're not. I've known Raj for a while, by the way. So it works, and it works for a conversation starter. But to encourage the people in the room that want to do something like this, you got to take it a step further. It's not just, I think on the last panel, the guy that was sitting here was saying, all hat and no cowboy, stuff like that. You can't just be sizzle. You got to back it up.
Exactly.
And that's what we do.
Excellent.
We do this just to start the conversation, and we're looking for long-term relationships.
For sure,
period.
for sure. Because I know, for example, Fadi said like the extent of your marketing is more like going to these events, and working really hard within your networks to potentially probably set up meetings, dinners, and
I'm
things
gonna get
like
one of those jackets too, though.
All the cool kids are doing it. I mean,
But it goes to show, right? But regardless, like RMC, you guys in Kansas City, you guys are the largest property owners in Kansas City. Am I saying that correctly?
Yeah.
Yeah, right. But do you guys see you guys implementing any of these type of like outside strategies, or you guys see that you're going to probably just stick to your guns?
I mean, we're lucky in the sense that, yes, we have investors in the room right now, actually, we sort of met through different conferences and stuff, but it's been really 99% word of mouth. We sort of were on the beaten path for a long time, where we were, I suppose, against the grain by being in the Midwest and the Southeast. I just read a report recently. We're the biggest landlords in Kansas City, but predominantly in the Overland Park area. And the report basically said the number one place to raise a family in the U.S. is Overland Park. We weren't that crazy 5 years ago. We didn't know the report was coming out. So it's sort of.
Did you anticipate that? Did you anticipate something like
I did,
that?
but nobody else. No, I didn't. No, we didn't anticipate that. It just.
You say it's luck? That was like luck.
We didn't anticipate it, but we knew it was a great area, and we saw the assets, and we, visiting the property, you kind of get, and you see what's going on, and you get the vibe in the steakhouses, and.
Any other great areas, like in the next, like where do you see great areas in the next 5 years, 10 years?
We really love the Midwest. Somebody was asking me recently, where will you be in 10 years? And I said, we're probably just going to be in the Midwest, but a lot bigger. I mean, we look everywhere. It's not that we.
Does politics influence that at all?
No, it's we look at the numbers, and what makes a lot of it is common sense stuff. Where can you get really high cap rates, and can you go in at a low basis? We go at people. We had questions about what about if there's a recession. We always buy thinking there's a recession around the corner, so we're very conservative. We keep tons of cash available. We buy at a really low basis so we can undercut everybody in the market if we need to. And if you don't have a recession, your numbers are just stronger. It's.
Do you see one coming?
It's a horrible question. No, but
I don't ask those either.
no pressure.
We've been talking about it. It's been talked about for 5, 6, 7 years, and
Yeah.
no one's got it right so far. So I'm
Yeah.
probably not the one to. All I know is if you have cash available to be opportunistic, it doesn't matter quite as much.
Yeah.
So that's sort of been our philosophy.
And self-storage kind of like, sometimes a recession actually helps you guys, right?
So it's a very defensive product,
Yeah,
right?
yeah.
So even in downturns, it tends not to do as badly as other asset classes. When people are downsizing or losing their homes, they want to keep their stuff. So they'll put it in self-storage, which of course helps our business. And then on the upswings, it does very well. What's one of the beautiful parts of storage is that these are month-to-month leases. So we can change our pricing on our customers every month if we wanted to. And for new customers coming in, we actually change that price daily. Right? Sort of like hotels and airlines do.
Yeah, it's becoming quite an interesting model. So anybody that's assessing kind of operational-based real estate, check and see what they're doing for revenue management, things like that, what teams they have in place. For example, now we've hired folks out of MIT, and they're more quant-related for pricing. Hotels price by the minute now. Everybody has always said the airlines irritate them when they go to book a flight, then 5 minutes later you go to book a flight and it's $200 more. The whole time hotels have been doing that pretty well and efficiently. So if you are looking at operationally focused real estate, right now assess the teams that are really doing the pricing models and how they're doing it. It's not the same anywhere where you can look down the street, make sure your sign is lit and match the price. You really have to understand the revenue management aspect of it.
And are you guys, and I want to ask you, because hospitality, subletting, things like Airbnb, like, are you guys on the lookout? Like, what do you guys analyze in terms of that?
Yeah, we get that a lot. A lot of people say, is Airbnb affecting the hotel industry? I think it's.
But you guys are in the boutique space, so it could be different, right?
We've done everything. So we've got a select service REIT. We've done large hotels. We're one of the top owner operators of Marriott's. Our largest hotel is a 650 room hotel in Disney. Our smallest one is a boutique in Nantucket of 10 rooms. So we're across the board there. Airbnb does affect the hotel industry but it doesn't affect it the same way that, for example, Uber affected taxis. We're still seeing business. I think it's just another part of the industry. Some folks call them the ankle biters of it, but we're not seeing too many rooms disappearing to Airbnb. For example, out of the room, how many people stayed in an Airbnb last night?
Yeah, that's a good question. How many people stayed in Airbnb last night? Raise your hand, nice and high.
It's about a couple. And then how many stayed in a hotel room last night?
How many people stayed in a hotel room?
So there's still room for that. Business travelers are going to stay in hotels. We like the Airbnb model
How many
in general.
people stayed in a self-storage facility?
If you do, I'm going to evict you. I just want to tell you that, all right?
That is not
You can't live
allowed.
in my space.
So overall, it's an interesting aspect to the hospitality sector, but it's not necessarily influencing our decisions, just based on business travel and dynamics.
Awesome. Do we have any questions from the audience? Questions? All right. I saw this gentleman first. JJ? Great. Mike's coming your way right now. Excellent. And the second individual I saw was the gentleman with the black turtleneck. And then if we have time, I'll try to get to the young lady with the white blazer.
It's kind of for everyone. I'm just curious how much, if any, ground-up development you do versus acquiring properties.
Yeah, so we do ground-up development very selectively. We actually finished one earlier this year, which I was very pleased to say, to be able to tell you all, we won Facility of the Year award for all of Georgia just last week. So it's kind of nice. But we're very selective on the development side. In self-storage, if you haven't noticed already, right, there's a ton of development that's been going on. It's mainly been in the infill markets, suburban markets, really sort of in different territories than John and I really play in, right? We look at those suburban, secondary, I look at the tertiary markets away from that competition. But there's been a tremendous amount of development, and because of that, in several markets, you just have too much development, right? They are overdeveloped in certain markets. And so we're very selective on our development side. And we have some large family offices and institutional partners that we work with on that side.
Excellent. And I'm actually, because I want to keep this answer to two panelists, so I'm actually going to send it over to
Good.
Fadi first for this one.
Ground up, we do zero.
Okay.
In office, it's a little bit complicated. You can make a lot of mistakes in office, so we buy off those who've made the mistakes in the development. So we don't. One of our partners is fully integrated, massive family out of Montreal, and they do it. So if we ever needed to, we could piggyback on them, but we just haven't needed to, and
Great.
it hasn't been opportunistic.
And yeah, hospitality.
Yeah, I'd say we've done it. We do it. I'd say it's less than 10%. We're very selective right now just because of where we are in the cycle.
When's the last time you guys did one?
We did one. I think we finished it and opened it up at Moxie Hotel, which is a Marriott hotel in Washington, D.C. I think it was the first Moxie in downtown Washington, D.C. We've done well and partnered with a group there. We did a development in San Jose, an AC Marriott. We just sold that last year. Absolutely crushed it on it. Did really, really well, but still we're very selective on development right now.
Excellent. Great. And the gentleman over here?
Hi, I'm Randy. At what point, it sounds like you put private equity into your projects. Do you at any point look at refinancing into long-term commercial loans to free up money?
So we're 4 years into our cycle, and the answer to that is yes. I've got 4 assets that I'm grouping together right now, recapitalizing. A couple of our investors want to get out. The rest of them want to stay in. So we're going to redeploy that equity and recapitalize the debt. We've done some bridge loans at like 6.6% interest. We're able to recapitalize that at 4.25% now. So we can cash flow our deals better, give a better return, etc. So we're in the life cycle right now of being able to do some of that on our assets.
Excellent. Does anybody else? Is that?
We're typically 65% leverage. Traditional bank debt, we're more favorable of versus CMBS right now. And for us, we'll sell anything that is not nailed down if it makes sense, and depending on who the partners are that we're partnering with, we can recap them out, refi out, stay along with it, get new equity partners or not. But we do a lot of we would do that.
Excellent. All right, so our time is now up for our 13th panel of the day. If we can please give a big round of applause to our panelists focused on real estate.